Okay, peeps, welcome back. So today we're going to be going over the macro markets and economics for January of 2024. Let's get it. So as you guys know, we do this once a month. Reason being, part of the reason is because it's extremely critical right now. The Fed is in the middle, kind of in between rate hikes and rate cuts right now. So it has a major effect on macroeconomics. For those of you guys that know this, you know this is true. Um, there's quite a bit of people that are viewing our channel that are in their 40s, 50s, kind of a little bit more older. They've been around for some of these market crashes. They know exactly how it works with the Fed, the kind of effects it can have, stuff like that. So that's one reason we do it. Second reason we do it is to kind of give you guys a general consensus of where the market is going, whether it's bullish or bearish, meaning, is it a good time to buy or is it a good time to sell? Some people do care about taking profits. Some people don't. Some people just want the dividends. To each their own. That's all I have to say about that. So, and one more thing before I get into the content, make sure you guys are hitting the bell notification and click all so that way you guys don't miss any future videos that we do or any updates that we have on anything. We cover crypto, stocks, macro indicators, Fed meetings, inflation, the works, you name it. So, first thing we're going to talk about is the SPX here. This is the actual S&P 500. As you guys can see on the weekly, ever since we broke this trend line, it's basically just been straight up. It's actually really been super bullish. We had 1 week of pullbacks, and that was pretty much it. Another 4 weeks of straight up. And that was after 8 weeks of green. We had 1 week of red and then 4 weeks of green. I don't think it's really necessary to talk about the 200-week moving average here. At some point in the future, if it becomes relevant, we'll talk about it. But we are way, way off from that 400-week or 200-week moving average, which is by this point in time should be somewhere down by this trend line down here. So we're pretty much above all the EMAs. Potential pullback area if we were going to pull back to it, which at this point I'm thinking we're probably not, is somewhere between 44.40 and I would say roughly about 47.50, maybe somewhere in there. The MACD is still very bullish. RSI is still very bullish. We're kind of tapping that overbought territory now. But keep in mind, it can, as you see in previous history, it can be up in that range for a very long time before it sells off. So it doesn't really mean much of anything when it comes to stocks. I would say things still look very bullish. I mean, we're sitting at all-time highs, so that's definitely a good sign. Now going into the NASDAQ, you guys can see NASDAQ is very bullish as well. We did just have some big tech earnings. I believe it was Apple, Amazon, and I want to say Apple, Amazon, and Meta. I'm pretty sure those are the ones, but they all came out and beat expectations, so that's really good. Although I think Apple dumped a little bit because they had some slight misses on iPhone sales or something like that, but not too worried about that. Apple's, they'll survive. So NASDAQ pullback area would be somewhere between 15,000 flat and roughly about 16,800, which surprisingly is right at the tippy top of this previous resistance now turned support. Everything else on the chart still looks very bullish, so there's not really a whole lot to talk about on either the S&P or the NASDAQ right now. Russell 2000 is still kind of stuck in this range, as you guys can see very clearly. We are, well, actually, not sure why this trend line looks like that. Maybe it's because it's on the monthly or something. I'm not sure, but we'll just go ahead and draw another one just for the heck of it. So basically, the support is sitting pretty much right around this support box here. So somewhere between 1605 to 1710, and maybe even as high as roughly about 1780 on the Russell. We're pushing up against this resistance again. Keep in mind, guys, the more that we test a particular zone like this one, the more likely it is to break. So we could actually see the Russell 2000 start moving to the upside here soon. I think it's more likely when the Fed starts cutting, but we'll just have to wait and see which one is more likely to play out. Dow Jones, really super bullish. As you guys can see, it is basically destroying all-time highs here. I mean, we're way, way higher than the previous high. on the Dow Jones by a long shot. Very similar to the S&P, we pretty much just had, looks like nine nine straight weeks of green on this one. Then we had a pullback, and then we just kept going up. So support is between roughly about 35,000 flat and 37,500, I would say. And we are getting overbought on the RSI, but once again, I'll say it one more time. I don't think it really matters a whole lot. What I would be more concerned about is if I started seeing some like bearish divergence play out, like how you have price going up here, but then you have the RSI slowly starting to make lower peaks here. If we saw something like that, that would be a little bit concerning, but we're not seeing that right now. So I would say everything is good. Everything still looks bullish for the indices. Pretty much almost all tech came out during this earnings season, which we're in right now. All of the Magnificent Seven almost. And pretty much all of them beat expectations, which is to be expected. I mean, they're the largest companies in the world. So next thing we're going to talk about is stocks above the 50-day. So let's see if I can get the right one here. So we'll start with S&P. As you guys see, based on this buy and sell zones we have up here. So when we hit the sell zone, we had a drop. And after it looks like roughly about 5 weeks, we are testing these EMAs, although I don't think the EMAs are really relevant on these particular indicators. What's more important is whether we're in that 90 zone or the 10 to 0, somewhere in there. So major overbought, major oversold. We have been kind of pulling back since we got into this area. Now, whether we're going to get an immediate pushback up there or not, that remains to be seen. NASDAQ is much closer to being overbought, clearly, as you guys can see. Although we have come down quite a bit, so there could be some room to run. Indicators don't really look too concerning. Once again, I'll point out the perfect time to buy from a swing trader and investment perspective, or as close to perfect as you can get, for a long position is down in this zone and a short position is up in this zone. We'll keep you guys updated as things play out with that. So now going to the 200. Hasn't really moved much in the last 4 weeks. We're pretty much still at the same spot that we were at before, not massively overbought, not massively oversold. We are more overbought than we are oversold, but we're not in one of these zones yet, so anything's possible at this point. Very similar with the NASDAQ 100 with stocks above the 200-day moving average. Now, you guys have to understand the difference between the 50-day and the 200-day moving average. 50-day moving average is more for like position traders, swing traders, investors looking to pick up deals at a discount in the immediate short term, whereas the 200-day moving average is much longer term. We're talking like Warren Buffett style dip buys here. Okay, so as you guys can see, the time frame between this low and this low here was 2 years. So this is kind of more for a long-term type investor who's really patient and willing to wait a long time to pick up the dip on some of these stocks. So next thing we're going to talk about is the yield curve. So just simply looking at the 2-10-year spread here, as you guys can see, we are roughly about 22 percentage. Sorry, that's not quite right. 32 percentage point spread between the 2 and the 10-year. We have not got the uninversion yet. In my opinion, I could be wrong about this, but just in my opinion, I personally think that the 2-10-year is not going to uninvert until the Fed starts cutting rates. That's just my opinion. So, because I think, I mean, in all honesty, that's usually how it happens, but the Fed's been in a pause for so long now that in my mind, if it was going to uninvert, it would have done it already. But you guys have to understand how bonds work. So when the Fed raises rates, bond yields go up, but bond prices go down. So typically what happens when the Fed raises rates, investors will flock out of stocks because they know stocks are going to dump because the Fed's raising rates, which makes it more expensive to borrow on a personal level and a business level. And that kind of affects profitability within companies. And if profitability within companies gets affected, then the price of the shares go down. and these investors don't want to lose their money, so they move their money from stocks over to bonds. Now, we haven't seen a drop in profitability in companies massively, and I don't think we're going to be honest, because this time is very unique, in my opinion, with all the stimulus and the illegal immigration, which shouldn't be happening, but it's kind of having like a knockoff effect on the economy, meaning that it looks like you would think that things should have dumped by now, but they're not, and they're probably not going to, because clearly what's going on right now has been carefully orchestrated. Um, so that's what usually happens. Investors don't want to lose their principal. They put their money in a safe 5%, treasury yield or whatever, and then they also, well, ultimately they end up making double their money because when the Fed cuts rates, the yield for bonds go down, but then the prices for bonds go up. So these guys are buying into bonds while the prices are at all-time lows and the yields are at all-time highs. And they usually lock in that rate for like 2, 5, 10, 30 years. And then as time goes on, these guys are probably going for like the shorter time frames, like the 3 month, 6 month, 2 years, something like that. So bond prices will go up when they cut, and then they'll make profit on top of the yield that they made. And it's more risk free than investing in stocks when the Fed's raising rates. So that's kind of, in my opinion, part of the reason why we have not seen yields drop hugely and the yield inversion take place yet. So next thing, Fed funds rate. You guys know that the FOMC meeting was yesterday. Powell came out and said that they're not going to cut rates in January, which we kind of anticipated. He indicated that there's a low likelihood of a rate cut in March, which I'm not so sure about that one. I mean, it's not like the Fed's really going to come out and be like, oh, yeah, guys, we're going to cut next month. They're not going to say that, okay? The Fed is not going to say something like when they first started raising rates, they said it months in advance, but they're not going to say that about cuts. Reason being is because if they say it prematurely, then inflation could go back up. They're worried about that, so they're not going to tell you in advance that they're going to cut. They're just simply going to come out and say it. So as for what Powell said about March, we'll just have to wait and see. We won't know that the cut's going to happen until it actually happens, and we won't know that that's going to happen because they're not going to tell us until the day of the FOMC meeting that they start cutting. So that remains to be seen. But as of right now, the Fed funds rate has not changed. So next thing we're looking at here is inflation. Looks like, core, or sorry, not core. Which one is this? Headline inflation went up slightly, but again, it's only 3.4%. That's not bad. Core inflation went down to 3.9%. So both are below 4%. That's a very good sign. The next CPI release is going to be sometime roughly around the middle of this month. We'll keep you guys updated on X as to what's going on with that. But as of right now, inflation's looking pretty good. Not low enough to convince the Fed to cut rates, according to them, but in my opinion, it's a lot better than 9%. So next thing is unemployment. Unemployment remained unchanged from the last time. We'll just have to keep you guys updated on this. I don't think it's going to change. Honestly, in my opinion, I think unemployment is going to remain extremely low. One of the big reasons being is because we're in an election year, and no presidential candidate wants unemployment to be going to the moon when they're basically up for term, okay? Because it looks really bad from a campaign perspective. But not only that, the $10 trillion in stimulus that was printed, that still hasn't run out, believe it or not. And so as a result of that, and obviously job growth and stuff like that, in my opinion, unemployment's not going to change. I would very much say that the soft landing scenario is still on the table. That's just my opinion. Of course, you guys are welcome to let me know what you think in the comments below. So now we're going to take a look at oil. So oil has not really changed that much. As you guys can see, though, recently it looks like we did have a drop. So we drew a zone here, kind of like an hourly zone for day trading. And it turns out we actually had a huge dump from that point. But looking back, it kind of makes sense because these wicks up here at the top of these wicks were basically when it sold off. So shorts were probably looking at that zone thinking, we could sell pretty much right about the top of these wicks and we're going to be making bank, right? We're going to be making money. A lot of money because oil is very, very lucrative. Trust me when I tell you. So we have had a dump. If this thing is going to bounce, it'll bounce somewhere in the zone between 72.25 and 74. But with the U.S. producing record amounts of barrels of oil per day and gas prices plummeting, which is good for the consumer, I don't really see a huge bounce taking place, but time will tell. So next thing we're going to look at is the metals. So we're going to move out to the monthly time frame, which is where we look at these at. Gold is slowly pushing up to new all-time highs, as you guys can see here. That's good for gold bugs. Me personally, I would not touch gold with a 10-foot pole. If I was going to buy gold, I would buy it in small amounts, very slowly buy it over time in like, 10th ounce, quarter ounce, something like that. I wouldn't be picking up huge amounts of gold at these prices. I would wait for probably at least a 50% retracement between the resistance and the support zone. So support's still the same. It's between 1380 and 1460, and support is between resistance, is between 1920 and roughly about $2,100. Silver, once again, stuck in no man's land. It's not doing much of anything. It's just kind of getting squeezed. So support between just under $9 a share to 14.50, and resistance between 29.80 to roughly about $38 a share. Copper has not had a huge sell-off, which is good. If copper sells off, that means that demand destruction is taking place, and that may not be good for the economy, but we haven't seen that, so that's definitely a plus. A little bit more expensive than silver, in my opinion, but the support is between $1.30 to $2 a share. Resistance between 410 to roughly about 510 or so a share. Palladium's still cheap, but again, it's still not in the buy zone, so we don't want to touch it. Support is between 850 to 1130. Resistance is between 2980 to 3400. And you know what's interesting about this? Just so you guys know a little history on us purchasing precious metals. We were buying some of the other metals. I think it was like gold and silver, and even some copper, while palladium was up here. And we were just thinking, like, yeah, dude, palladium's at $3,000 an ounce. The support is all the way down here. Yeah, we're not going to touch this thing with a 10-foot pole. And I am really glad that we did not, because as soon as it hit the top of this zone, it just absolutely got destroyed. So, yeah, if you had bought palladium at the top here, you would have lost, assuming that you sold, you would have lost about 60% of your value. So last one here, platinum. I would say platinum's kind of stuck in no man's land. So support between 700 to 830 a share, and resistance roughly about 1170 to 1335 per share. I would say it's pretty cheap. I don't know. I mean, Russia is actually a big, what do you call it? They're a big exporter of platinum. There's a lot of a lot of platinum that gets mined in Russia. So you got about 45% upside on that if you wanted to pick it up on the dip. That's entirely up to you. So the next thing that we're going to look at is we're going to look at the DXY. So dollar index has not done much. We did have a death cross here, or a double death cross on the indicators, but dollar hasn't really done much. It's kind of just went sideways, bobbed up and down a little bit, but still sitting on support. Keep in mind, Bitcoin and the dollar have an inverse correlation. So until the dollar index has a massive drop, which in my opinion is not going to happen until the Fed cuts, because remember, treasuries are considered to be cash equivalents. Okay. So people have their cash in treasuries, which is paying them more cash through the yield that they get through treasuries. And the amount of money that's in stocks right now is very small, and in crypto compared to treasuries and cash. Okay, there's still record amounts of cash sitting on the sideline. So until that shift takes place, the dollar's probably not going to dump. And, unfortunately, I hate to say it, but Bitcoin is just going to have to wait. We're going to have to wait to get a sell-off in the dollar for Bitcoin and stocks to really start moonshotting. So kind of the key takeaway here is to get below this red EMA and the support at $100 even. So next thing we're going to look at the VIX. VIX hasn't done much, still sitting in the support box. If we see the VIX start basically moonshotting pretty much up to between 40 to 52, you know that there's about to be some serious dumping in the markets, or it's happening as it's going up, and we will definitely keep you guys up to date on that. But as of right now, there's not really much going on with the VIX. It's kind of just looking very similar to what it was. um, we usually cover Bitcoin in this, but we're going to keep that in separate videos. So anyways, hope you all enjoyed the content. Please like, comment, and subscribe, and we'll see y'all later. Peace.